The Fed funds rate goes negative for the first time in history. It's breaking news. Um, I've seen all this news about the negative Fed funds rate, and it's not fake news. It has to do with futures contracts, and I want to explain what the Fed funds rate is, I guess, and how it relates to the stock market, and where this negative rate is coming from, and really the big thing is, how is the Fed intervening in the Fed funds rate, and how does it work, and what are they controlling? And this is a really important point, and I'll show exactly how it relates to the S&P chart and the whole model that I have, like all of the ascending lines on everything bubble. This is Brian Lewis with MMT Investing, and things just changed. So I'm trying out, I got this African style paw filter to see if I can clean up the microphone sound a little bit. Just joking around. We have to wear these, masks to the grocery store now. They've changed the lockdown rules. I'm locked down in South Africa near the safari park. And everyone has these kind of wild pattern masks that they're wearing around. So I want to take a look at the Fed funds rate. This is a long-term chart from 55 to current. And you can see just this kind of up and this kind of down thing. And this has been doing this pattern no matter who the Fed chair is. And I've been working on some Bollinger Bands on the S&P. I was going to do some Bollinger Band stuff today, but then the Fed funds rate news came in, and the Bollinger Bands on the Fed funds chart are really good. Like even better than they are on the stock market. And you can see exactly how the Bollinger Bands work here. I'll explain the bands. I'll explain the Fed funds rate, how they change, where the Fed's intervening, how they're controlling it, and then the stock market. So I'll point out here, this is where Volker is the Fed chair, Paul Volker, the late and great Paul Volker. And he's occasionally blamed for creating inflation, and he's often credited for fixing it with setting a super high Fed funds rate. And let's go just run up this thing here and look at the Bollinger Bands. And you can see the pattern. So when you're going up, you stick kind of the top edge of the Bollinger Band. When you're going down to the bottom edge, up, top edge, down, bottom edge, up, top edge, bottom edge, top edge, bottom edge, top edge. So, I mean, you can see how the Bollinger Band trading works. And this is the treasury rates that people are trading in the open market. And what the Fed funds rate is, it's the interest rate that the Federal Reserve Bank gives to the primary banks. And that in turn is closely related to the rate that your bank will give you, like in your savings account. So if you see back here in the 80s, I don't know if a lot of people realize, but in the 80s, the interest rates were close to 20%, and that's the amount of interest that you would get in your savings account. Like close to 20% is the return of just having money in the bank. And that's kind of crazy. And those interest rates were devastating to trying to buy a house, because that also affects mortgages. So people were saying like no one will ever buy a house again at this point. And then everyone was keeping their money in the bank because you get a huge interest rate. That's what was going on back then. And then Paul Volcker, set this interest rate at this super high level and freaked everyone out. And he's trying to fix the inflation problem with a really high interest rate. And he always smashed that like button right now, please, to help me out with the YouTube algorithm. But what you can see here is this is just a normal trading, sort of bubble uptrend with really super normal Bollinger Band movements, and there's not a whole lot of crazy stuff. I mean, you get like a little bit of volatility here on the crossovers, and then kind of swings around the tops here. And you get a really big swing around the top here. So, I mean, this is one spot where the Fed might be intervening a little bit, like trying to set rates during this volatility when they don't really know what the trading is or where to set it. And it just reverses when they set it wrong. It just reverses really hard to where it should be. And then Paul Volcker, sets these high rates up here, and that's just exactly where the trading would indicate to set it. I mean, it's just the normal market rate. They just set it at the normal rate, and then it continued with the pattern. And if you look at the trading here on the backside down, this here is where the everything bubble starts. Like this is the floor baseline upward bull market trend line that we get on the very base of the everything bubble. This is the everything bubble floor right here. And it starts right here at this high peak. And I'm going to go down this Fed funds rate and look at what we've been trading and how the Fed has been intervening a lot more recently and what effect that really has. And let's just take a look. So on the way down, it's the same kind of thing. You get the down moves on the bottom of the Bollinger Band, ups on the top, downs on the bottom, ups on the top, downs on the bottom, ups on the top, and kind of a sideways one here. That's like a down on the bottom here, I guess, but up on the top, down on the bottom, up on the top, down on the bottom, and then we hit this super bizarre thing where the whole Bollinger Band collapses, and this is the zero interest rate policy of Ben Bernanke, helicopter Ben Bernanke, where they would not let the interest rate go below zero, even though it wanted to. And this is the huge quantitative easing intervention and the zero interest rate policy of Ben Bernanke here. And I'll come back to that in a minute. But let's get right to our thing right here, and I'll talk about the futures and the negative interest rate, and talk about the bubbles a little bit. So, as you can see here, we went up on the top of the Bollinger Band. Now we switched over, and we're going down on the bottom edge of the Bollinger Band now. And starting back here in around 2000, right? This is the dot-com bubble. You start getting these flat lines. Flat line here, flat line here, flat line here, flat line here, here. This is the big Fed intervention. They're intervening in setting these hard lines that last for several months. And I'll explain how they're doing that and the tools that they have. And this is the big one. This is the Bernanke flat line, the zero interest rate policy. Then you get one here and a little one here. And so there's basically two tools that the Fed uses. They use open market operations where they buy securities, usually treasuries. But the Bernanke plan has been expanding what they can buy into the bond market and into the real estate, mortgage-backed securities, and potentially into the stock market soon. And he wrote a whole, I guess, like a white paper. Before he was the Fed chair, he wrote a whole white paper on how the Fed could intervene to fix these interest rates going down, which looked really bad for the dollar because negative interest rates make the banking sector basically unprofitable, and how the Fed could intervene and fix everything. And that's what the Fed has been trying to do here with the zero interest rate policy, and that's why the balance sheet is going to the moon, starting here at the bottom of the financial crisis crash. And what you can see is with all this Fed intervention, you get just the super normal chart that you would expect, and you get the same Bollinger Band movements that you would expect. And the only difference, all of the Fed intervention, the only difference it makes is instead of this little top here being rounded, it's flat. Instead of this bottom being rounded, there's little stair steps. Instead of this top being rounded, it's flat. That is all the Fed intervention does. And this one is a monster because this one would have been a rounded bottom like this. That would have gone negative, and they did a super long Fed intervention to stop it from going negative. And it's really, really expensive to do that, and it has, major implications on on the dollar in general, but this is all the Fed intervention does, and the open market operations where they're buying treasuries and things like that to control the yield curve is part of it. But if you listen to Jeff Snyder, it's really funny. Jeff Snyder always talks about how the Fed, their number one tool is not open market operations. And if you look at the history, you can see that it's just pretty normal trading patterns for the treasuries. And they're not really controlling anything. They're just kind of watching. They're just watching where it goes and they're announcing where it is for the most part. And Jeff Snyder says that the Fed's number one tool is not open market operations. It is psychology. It's press releases. So the Fed's number one tool is a press release. They watch where the thing is going. And then once it gets to a level where they can say like, okay, we know where it is now, then they'll come out with a press release and they'll be like, okay, the Fed funds rate is this level right here, and they'll set the Fed funds rate and that's just where it's trading. And then once they set it though, that makes everybody think they're controlling it at this level. And they don't really have to do any special operations at that point, and they usually don't. They just do their normal market operations. And everyone tries to trade at that Fed funds rate because they've said it. They've just come out and said that's the rate. And so everybody tries to trade at that rate until it doesn't make sense anymore and the market just like pulls it in the other direction. And then they just kind of start watching it. And like this, you get the emergency Fed funds rate that happens at some arbitrary time that's like not on their schedule. Because you're in the middle of a crash and they're just like, we have to announce a lower rate because we're in the middle of this down move. So they come out and announce a rate and it stays there for a couple months and then continues going down. And this is quite a thing though. This is a really massive intervention. And I don't know. I mean, it's probably not a sustainable kind of thing. And I don't know how far under here it would have gone anyway. It probably was just barely going to go negative as it was. But that's what Jeff Snyder says, that their number one tool is psychology, and they just come out with a press release when they figure out where the rate is. They have to watch it, figure out where it is, and then once they see where it is, then they're like, okay, this is the Fed funds rate. Now we're gonna do all of our magical Fed stuff to keep the rate at this level, and it just works for a little while until it moves, and then they just figure it out again and announce the next one. And that's what it looks like to me, except for this thing here. This is a pretty aggressive thing. And this is where they're getting in there and blowing up the Fed balance sheet and buying all these different securities, all the mortgage-backed securities, and just like holding them on the Fed balance sheet. So, I mean, right now we've had basically a couple emergency announcements of Fed funds rates already in this crash. And this downwards move in the Fed funds rate probably started in the middle of 19. Oh, you know what? This is when the repo market started going nuts. This reversal point right here is the repo market madness, and that's where the Fed funds rate is starting to reverse. And then they tried to hold it here and it didn't work, and now we're all the way down at zero. It's like point whatever it is as of last month, and I mean, the futures prices right now coming out and saying they expect a negative Fed rate for 2021. Like, I mean, if you use Bollinger Bands, you should expect a negative Fed funds rate like this next one. I mean, you're not going to just bounce off of that down move. Like, this is a swinging wave pattern, and it looks like it's going to try to go negative right now. So I don't think this is crazy for the futures to be saying that we should be pricing in negative interest rates right now, but it does have really serious implications for the worldwide banking system. Like, banks basically can't be profitable at negative interest rates, and if their reserve currencies are negative, I mean, we saw what it did in Europe. It was really, really bad for the banks in Europe. They're just not profitable for like the last 10 years, it was like the first time in forever that banks were just not really making money, and it was, yeah, it's just crazy right now in the banking system. But let's talk about the shape of the S&P relative to this thing. And so yeah, in 82 we get kind of the floor of the everything bubble coming out. And then in the 2008 crash, around 2009, we get a higher trend line. So we start trading on this trend line, and Black Monday was, where was that, 87 or something like that. Yeah, we got like a Black Monday bubble here that crashed, and it stayed on this trend line. And then we got a reversal here into a higher trend line in 2008, but also the dot-com and the housing bubble happened above this trend line, and the financial crisis crashed right back to the same 1982 Volcker trend line down here. And then we get this higher angle trend line that came out of the financial crisis. And this is our 12-year bull market line that I always talk about in the videos. And on top of that line, around it was the end of 2018, like January 2019, like here, we got a steeper trend line. And that was kind of the rise up to the blow off top of the everything bubble, and then we just get like a little tiny parabolic blow off. And right now we have broken and back tested that line, and we have broken and we're like back testing this financial crisis line right now on the S&P. And that's the shape of the bubble, and the interest rates going negative. And this is why I'm projecting another turn down, but it's hard to predict the timing of these things because you have to get back up to this trend line. After you break the trend line, you start back testing it, you get up and you back test it, and then there's action on the line. And just like we saw with this Wallmageddon line, at some point you terminate the tangent line, and then you can start heading down towards the next tangent line and potentially break it. But this is a floor line for the everything bubble. So if you look at my other videos, like on the Nikkei and the Great Depression, I did the NASDAQ bubble recently. You can see what it looks like when you get down near the floor line of the bubble. It's not quite the same as when you're breaking these top bubble lines. But that's what we're trying to track on the channel, is the shape of this bubble and how it looks on the way down when you're unwinding the bubble. You know, and everyone says like, okay, the Fed, they're pumping everything up and they're doing all this stuff and they're propping up the market. Well, I mean, are they really doing that? Because that's what governments always try to do in every bubble. Like that's what blows the bubble up in the first place, is overprinting all the assets, all the currency units, to where the backing of the money is not backing the money anymore, basically. And then more printing does not keep the money from coming down. I mean, Japan was the king of printing. Like they're like the pioneers of quantitative easing. They printed and intervened, and the Japan bubble came right back down to the floor. And then you see what happens after that. I mean, Japan had like a long-term bear market after the bubble, and like a deflationary. Japan had deflation while they're trying to print crazy amounts of money. And their bank was doing QE. They're getting deflation. So just like the amount of control that the Fed has over these interest rates, over the whole pattern, like over the amount of money they can print, like there are limits. Like at some point, you reach the limit of how much you can print, and the money is just not really backed anymore, and the bubble unwinds. It's what happens every time. It's just the basic. It's a sovereign debt bubble. It's not the same thing as like a Bitcoin bubble or something like that. Like these are credit cycles that expand up at increasing levels, and then they unwind in a specific pattern where you back test these levels and come down. So that's what I'm tracking on this channel. And this Fed funds rate gives you a very, very good look, especially with these Bollinger Bands, about the kind of control that the Fed actually has over these rates and where they're trading. And I guess the longer term implication of this whole chart here is basically saying when the interest rates are naturally very high, that means that the economy and the dollar is extremely strong. And that's the supporting point of a whole bubble. And as you get down to zero or negative, that means that the economy is super weak, and that's kind of the reversal point of a bubble. And that's where we are right now. Feb 2020 was the blow off top of the everything bubble. And I don't know, I wish this chart kind of went back farther because there was a bottom here in interest rates and it reversed to a long-term uptrend. And we'll probably do that again sometime here like that. And that's the trading pattern, and yeah, that's pretty much the idea here. I think that's good enough. Please hit the like button to help me out with the YouTube algorithm, and I'm trying to get to 1,000 subscribers so I can monetize the channel. So this week I'm planning on doing less videos and focusing on trying to bring subscribers into the channel to get monetized so that I can keep producing this content. But yeah, if you like this content, please like and subscribe so that I can keep doing this, because it's costing me money to do this right now, and I can't do this forever unless it gets monetized. And yeah, okay. I think that's good for the Fed funds rate. This is not financial advice, and yeah, I would take a look. At Jeff Snyder talking about the kind of control that the Fed actually has over this Fed funds rate. And then also Warren Mosler, the MMT theorist, is pretty funny when he talks about the Fed controlling these things. Like Warren Mosler says that the Fed is like, you can put like a little like a fake steering wheel in the passenger seat of your car for like a kid to like pretend like they're driving. That's what he says. He says that the Fed is like a little kid with a fake steering wheel, and they think they're steering this thing, but they're just following where it goes. I think that's pretty funny. And then Jeff Snyder says that the system like broke in 2019, and the international banking system is in a ton of trouble, and the Fed is just not controlling the interest rates anymore since 2009 or whatever. But if you just look at the chart, I mean, the chart tells you more than anything else. Like you can see right here where it trades, and they're just normal trading patterns. I mean, how much can you think there's a person like a genius at the Fed that knows exactly where each point on all of these trading patterns is and sets them like every month? Like, no way. This is a completely normal market trading pattern, and it's relative to this whole bubble. Like, this is not planned out in advance and marked every day by some genius. This is just a market trading pattern. And you can see where the interventions are, and they're small and they don't change the pattern. They just slightly flatten out areas of the curve. There you go. That's your Federal Reserve right there. And this is the everything bubble, and the US dollar right now is in a weird situation. So we'll see. We'll see what happens as we unwind this bubble and really try to track the inflation rates. That's a big thing. But as I mentioned in the inflation video that I had last time, is that during the crash, the immediate crash, inflation is not going to be a scary issue. But as we move out of the crash into a monetary expansion, that could get really interesting to see if we can get inflation in a higher trend line, or if we do like the Japan thing and we can't get any inflation and go on a lower trend line. It's hard to predict the inflation, it really is. But it's not hard to predict that that the Fed is not really controlling this thing, other than just flattening parts of the curve out. And yeah, that's good. So happy trading, and I'll get some Bollinger Bands going on the S&P and look at the. I'll take a different look at the MACD levels on the S&P and see exactly where we are and how to kind of trade this bull run that we're getting right here off the bottom. It's pretty crazy. There's a couple things happening right now that are unprecedented and they're just really hard to predict. But we're gonna take a look at some patterns and try to figure out the best way to be safe in this craziness. And yeah, okay. So happy trading.